Navigating the current housing market presents significant challenges. With soaring mortgage rates and record low inventory levels, achieving the American dream feels increasingly elusive. Join us for Real Estate, the New Reality, as we examine the crucial trends and shifting supply and demand dynamics shaping the nation's housing landscape. Housing market might just be too legit to quit here. Pending home sales, which measures the volume of signed real estate contracts in a given month, it jumped unexpectedly in March, up 3.4%, even with mortgage rates continuing to rise over 7% here. More people are out there. They're putting in offers on homes. So if you are in the market for a new home, what should you be taking into consideration about the market right now? Joining me now, and this is Mariana Nero, who is the Sirhan, Florida founding agent. Great to have you on with us, and thanks so much for taking the time. I took a look at some of your listings, not shabby at all, and of course, the Florida market booming, especially post-COVID. So all of these things considered, what are the top considerations that people going into this spring buying season should be keeping in mind?
Okay, Brad, thank you for having me here. Definitely they need to define if they're going to buy cash or if they need a finance. If they need finance, they need to get ready before searching for properties and putting offers. With the pre-approval loan from their lender, with that letter, they're gonna understand better how much they can afford. Maybe they can afford more than they think, or maybe they can afford less. So then they can filter and do a better search. And with that pre-approval letter, they're gonna have a lot more power while putting an offer and negotiating a property.
I wonder what you're seeing in the negotiations right now, especially in the market that you're within, and where you're seeing buyers kind of come in from. It's probably not first-time home buyers based on some of the listing prices that I had seen for your listings, but at the end of the day, there's a lot of just conversation about where they're trying to make sure that they're negotiating properly for themselves.
Yes, we see buyers from all over, especially I'm in Florida, down in Florida. We have a lot of people, a lot of Latins, but we have a lot of the US new buyers. We had a suppressed demand from the last 24 months from buyers that didn't pull the trigger that we see now jumping to the market. And that's why we see the home sales increased in the last few months, especially this year.
Just lastly here, before we let you go, where do you see the market moving as you kind of look out into the rest of the year? A lot of potential buyers that are still on the sidelines, just waiting for potential rate cuts.
Yes, don't wait for the interest rates to start to drop because prices will skyrocket. What I tell everyone is that every half a point in difference in the rate is only $33 monthly with principal and interest in every $100 that you borrow. So it's not a lot. It's better for you to just negotiate while your prices are still low because prices will jump once the interest rate starts to drop. And that's the trend.
High mortgage rates sticking around as they continue to climb past the 7% threshold. Elevated rates lending to wealthy buyers purchasing homes with cash, leading to a rise in prices. According to Redfin, luxury home prices rising twice as fast as non-luxury prices in the first quarter. Joining us for more on the latest trends among affluent buyers, we have Brown Harris Stevens CEO Bess Friedman. Bess, thank you for joining us here today. So just give us an overview here of the luxury market versus the rest of the real estate market.
Well, I think the luxury market is also being challenged by what's going on with rates, although a lot of the time, and last year we saw a lot more cash buyers, and we're seeing more of that even in the first quarter of this year. It still has an impact with the higher rates. And then first-time home buyers are really highly impacted by these higher mortgage rates. And so we've seen a slowdown with sellers and buyers last year because of the higher rates. And it's continued into 2024. The first quarter was not a great quarter, let's be honest. The housing market is stalled because of a lack of inventory in certain places, higher rates, and prices have stayed higher because of that. But the month of April, so far, it's looking a little bit better. We're seeing incremental progress in the housing market. Look, there was a lot of money for the Wall Street bonuses. I think it was something like $33.8 billion was paid last year. A lot of cash out there, so we're seeing a lot of cash buyers as well. So It's not awful, and it's not champagne and caviar.
Talk to us about price, because we mentioned that figure coming from Redfin. On the other hand, we've seen some stories in the press about how luxury sellers have had to cut their prices and sort of come back to earth a little bit after what we've seen the past few years.
Yeah, I mean, it just depends on how do you define luxury. So in Manhattan, we have this sort of measure that, over $4 million it is probably luxury, but for the rest of the world, that's crazy numbers, right? And so it just depends. But Manhattan is a little bit different. We kind of put that in a little bit of a bubble, similar to Palm Beach and certain areas of Connecticut and the Hamptons. But the rest of the country, those prices are crazy. And I would say over $1 million is probably considered luxury. And most of those people who are spending $1 million are getting a mortgage. And so the rates they're very sensitive to, and they're very value focused. So if the rate is a little higher, they want to do better on price. So I would say they should talk to a mortgage professional and talk to a real estate agent who can guide them so they can find something that is affordable for them every month.
What about inventory? Talk to us about that, because we still have we have people sitting in their homes with 2.5% and 3% mortgages. They don't want to sell necessarily. How does this look in the luxury market?
I mean, that's a little bit different. So what you just said about the sellers that don't want to put their homes on the market, they don't want to let go of those low rates. And why would they? Unless they're motivated to sell because of a change of life or a new job, they're probably going to stay in their home for a little while. But luxury is a little bit different. And that's why people are paying cash when they can, because they're not going to be impacted by the rates. So the luxury market has done okay, but still, because of what's going on, there's chaos in the world. And that distracts people. We have 2 wars going on. It's an election year, as we all know. It's a hot topic everywhere. And, the media, the news cycle keeps people distracted. So I think we're in a little bit of an environment where there's a bit of uncertainty, and that kind of keeps people on the sidelines, which is why it's been a little bit slower in housing, including luxury, because that's discretionary. And when people see that things, are working a certain way, this way, that way, rates have gone up, the stock market has done well, they kind of hold off.
Tightening spreads and debt worries tainting the look of the commercial real estate market this year. But our next guest says fundamentals for the market are sound. For more on the bright spots and storm clouds of the commercial real estate space, let's get to Marcus & Millichap CEO Hessam Naji joining us here as part of our week-long special, Real Estate, the New Reality. Hessam, it's good to see you. And maybe, we talk about CRE a lot on this show. And maybe we'll just start there, Hessam, kind of your 30,000-foot view of the sector. How healthy and resilient does it look?
Good afternoon. Thanks for having me on the program. We really have to separate the property fundamentals and property performance from the capital markets, interest rates, and valuations. On the property fundamental side of the equation, the industry as a whole is running something in the neighborhood of 90 to 95% occupancy rates, except for the office sector, and is not seeing a massive overbuilding problem or rent collection problem or any kind of a reversal in healthy occupancies. What we are seeing is pockets of overbuilding for apartments. We're definitely seeing pockets of overbuilding for warehouse distribution facilities, which has been really driven by a lot of e-commerce growth over the past 10 years. And other than those two, there is really no signs of any kind of a performance concern or occupancy concern. The office sector is a whole different story. And even there, we have newer properties, especially in suburban markets, that are running on average 11, 12% vacancy rates. And then there's urban office, especially older ones, that are running 25 to 30% vacancy rates. And those happen to get a lot of the headlines and a lot of the focus because of hybrid work solutions and people being reluctant to come back into the office full time, which are legitimate problems. Many of our clients are reporting continued headwinds against getting people back in the office. But it's really limited to urban office, especially the older stock of office buildings. On the capital markets, interest rates and valuation side of the equation, we're still seeing a big bid-ask spread between buyers and sellers and reluctance by banks and credit unions to be actively lending in the market. So that is still the most the biggest area of challenge.
And Hessam, I noticed that the group, in terms of sentiment around the stocks, has not been great. That's true of Marcus and Millichap. That's true of real estate investment trusts. It's really true writ large here. And do you think that that sentiment basically has to do with what the outlook for interest rates, and that perhaps the stocks can't recover until we get a little bit closer to when we might actually see cuts?
That's a great question, and there's a direct correlation between the groups, the entire sector's valuation movement, and Fed sentiment. We saw a big run-up in the sector's valuations late last year when interest rates were coming in. You know, the 10-year Treasury had peaked around 5% and then pulled all the way back down to 4%, and you saw the stock prices go up accordingly. And then when the Fed basically changed its mind again, given the inflation readings of the last couple of weeks coming in hotter than expected, and now the notion of delaying the easing cycle, you see the stocks are under pressure again. So there's a direct correlation between Fed expectations and interest rates because of the fact that the cost of debt is such a paramount element to evaluating commercial real estate. The vast majority of transactions use debt in some form. Typically 60 to 70% of the value of an acquisition has been financed, whether it's banks, credit unions, insurance companies, and other forms of lenders, the CMBS market and so on, agency lenders for apartments. And therefore, the sensitivity to the cost of debt has a direct correlation on pricing. And it's not a surprise to see that tight kind of band.
Hassan, I'm curious, when you're talking to your clients right now, what are they most interested in? Where do you see the strongest demand?
You know, it's interesting. There's been so much focus on the Fed, and everyone, at least psychologically, still waiting for the Fed to break the cycle of tightening and introduce the cycle of easing. And there's a lot of kind of dependency on that timing and the shift for when people, I think, are going to become much more aggressive in coming into the market. Meanwhile, what's interesting is that 2 years has now passed since the tightening cycle, and that time frame has brought price corrections, has brought some distress, operational distress, not so much, you know, industry-wide big sell-off of major portfolios, but operational distress in many different product types and markets. And therefore, more properties are coming to market at prices that are far more reasonable. And they're very competitive with replacement costs. One of the most important metrics for commercial real estate investing is replacement cost. And so a lot of our clients are actually seeing that replacement cost is not much higher than the price they can fetch current assets. And therefore, they're moving ahead even before the Fed really confirms its intention to bring down interest rates with the first, reduction. So we're seeing more activity. We're seeing more properties come to market through exclusive listings because those sellers that were waiting for a Hail Mary from the Fed are now seeing that that's not going to come. And interest rates are, even when they start to come in, they're very unlikely to go back to where they were, which was near zero for quite a long time. So there is a whole recalibration and adjustment in the marketplace that's happening as we speak. It just hasn't quite finished its process yet.
Hassan, great to see you. Thanks for joining us as always.
Thanks for having me.
New home sales surged in March, up 8.8%, as buyers turned to those turnkey properties amid a persistent shortage of pre-owned homes. High mortgage rates are keeping current homeowners locked into their properties and low rates. So, what are the options out there for those ready to buy right now? Our very own Danny Romero is live. She is ready to buy too, from a building and this property in Long Island as part of our week-long special, Real Estate, The New Reality. Danny, what can you tell us about this? I mean, beautiful staircase, by the way.
Brad, it's open house at this Toll Brothers community in Dix Hills on Long Island, New York. This community was opened fall of 2022. There are about 30 homes specifically in this community, and the starting price tag for a home similar to this or down the block is about $2 million. Now, it does take about a year to build out a home like this, and the home lots on average are about 1 acre, but a home itself is about 4,000 square feet to 5,200 square feet. Again, there are about 10 to 12 homes still available, and there's actually one home that is move-in ready, and you can move in as early as September of this year. Now, of course, these homes, these beautiful luxury homes, offer a plethora of amenities. Some of those include a basement, a stunning outdoor living feature like a pool. And most of these homes have about 4 to 6 bedrooms or 2.5 to 5 bathrooms, Brad.
And so what kind of incentives are they offering? I mean, we're taking a look at some of the features here that you were running through, but what are the incentives?
Toll Brothers customizes their incentives to their buyer. And the popular incentive across all home builders has been the mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan. And for example, for Toll Brothers, they are currently offering a mortgage rate of 5.8% for their move-in readies, but that's not really applicable for this community specifically in Dix Hills. But the CEO did say on their first quarter earnings call that the majority of their buyers do qualify for the average market rate of a mortgage rate. So they're not really using the buy downs. Instead, they're using those incentives to help lower closing costs and to use some of that money for upgrades and amenities, Brad.
Wow, that home just screams Restoration Hardware. Danny Romero, thanks so much for taking the time here with us today. Appreciate it.
Well, it's not just in New York City. Affordability remains a pain point for prospective homebuyers in many areas. High rates creating little opportunity for entry-level buyers such as millennials and Gen Z. The shifting housing landscape lending to a shift in trends among the different generations. Here to discuss as part of our week-long special Real Estate, the New Reality, we have Dave Liniger, Remax co-founder and author of The Perfect 10. Thanks for being here. Appreciate it, Dave.
Thank you.
So we just heard Danny talking about affordability here in New York City. Obviously, this is an issue in many areas around the country. What are you seeing from this Gen Z millennial cohort in terms of whether we are going to see the same level of home ownership that we once did?
Well, currently you're not going to see it. Housing affordability is a terrible challenge for everybody. Interest rates have gone up, and that means a bigger down payment or a higher monthly payment. And so with the limited amount of inventory we got, a tremendous demand for real estate prices keep going up.
You know, and I want to talk about some of the trends that you're noticing here with Gen Z in particular. They are shunning college in small numbers for trade school, and just maybe outline some of the benefits there and reasoning why they might doing this and how it fits into your housing thesis.
Well, there's a couple factors. Number one, we don't have enough of the trades, and the trade income has skyrocketed. And so a lot of times the younger generation is taking a look. College, the cost, borrowing money and paying on it for 10 or 20 years for maybe a good income, when you can get a great income right now in the trades. I mean, there are welders that are making $100,000 a year within 2 or 3 years of trade school. So practically speaking, why go into debt if there are trade jobs that you want to do and you can make just as good of money?
So does that mean then that maybe the spending power of this generation will actually be a little bit stronger than some of the worst predictions are saying?
Yeah, I think the predictions are wrong. The millennials and the Y Gen especially are much thriftier than any previous generation. I believe that comes from watching their parents struggle in 2007 and on, and all the foreclosures and the things that happened. I think it's made them much more frugal about their money. And so their savings are doing much better than previous generations did.
Well, that's impressive. I want to switch gears a little bit, talk about the National Association of Realtors settlement and the impact that may have for anybody who's considering buying or selling a home now.
It's hard to tell what it will do. Part of the settlement is more transparency on the part of the realtor. Part of it is that if a realtor is a buyer agent and he's representing a buyer, he has to have an agreement in writing with a fee structure in writing that has been agreed to by both parties. Over the past decades, the seller paid most of the commission, split it between companies, and so the buyer agent was saying, basically, you're getting my service for free. Now the buyer agent, it does not necessarily have that, and the buyer agent's going to have to justify, what did I pay you for what you did?
I mean, even though the change is still, the exact impact is still sort of TBD with this. I mean, you just wrote a book called The Perfect 10. I imagine you've been reflecting a little bit on what you've seen over your career in the industry. How do you sort of situate this amongst the other big changes we've seen over the years in the housing market?
Well, I think the litigation explosion is certainly going to have an impact on the industry. Whether it's going to have a huge impact on the cost of buying and selling property, nobody knows for sure yet. The one thing it will do is it is going to start eliminating the massive numbers of low producers and part-timers in the industry.
Dave, we got time for one more here. Anything you want to talk to us about? Give you the floor here.
Well, I think the thing is that interest rates will come back in line, but do bear in mind, over the 50 years of Remex's history, the average interest rate, 7.78%, exploded to 17% back in the early 80s. The last 15 years are unreal.
Oh, well.
What does back in line mean?
I think you're going to see 6% mortgages, the mortgage rate of the future.
All right. Well, we'll have to have you back and see if that comes to fruition here.
I hope
Appreciate you coming by here, Dave.
Thank you.
We are going to turn to the housing market. We're seeing innovations in commercial real estate, with commercial properties turning into actual residential housing. Joining us right now from a property just like that is our very own Danny Romero, and she is joined by Joey Chilelli, Managing Director of Van Barton Group. Danny, take it away.
Maddie, look, you're taking a look at the future of housing right now. This was a WeWork location that now is being demolished and is going to be converted from office to residential. And I'm joined with Joey Chilelli, Managing Director of Van Barton Group, and they are in charge of demolishing this. So when did this phase start?
Yeah, this started about a month ago, actually, the demolition phase.
And how long does it take to fully convert from office to residential?
This space here will be about 12 months in total.
Okay, and what have been the challenges specifically for this project when converting?
This particular location and project is, some of the challenges were more of lining up the unit walls, perimeter walls, to the mullions of the windows. And making sure that we created really marketable and livable units without a lot of the jogs in some of those perimeter walls.
How many would you say apartments will be in this building?
About 75.
75. And what
Yeah.
would be the range of how much they would cost-wise?
On average, say about 4,000.
And back to, we've seen a lot of states and cities move forward with incentives and programs to offer for developers like yourself in converting office to residential. Does the math actually math?
It does. It does. So in this particular location, in this project, we are not receiving any incentives or tax exemptions. And so you really need to weigh what the cost would be to upgrade this location to more of a Class A office, what the rents you could get for that are, as well as the tenant improvement dollars that you would have to spend and the leasing commissions that would need to be spent, and the time that it would take to lease that up as office compared to residential. The city has a vacancy rate of 1.4%. So the time to lease this up for residential would be dramatically less, and the costs would actually be less than the overall dollars that would need to be spent for office. And it goes to say that the tax incentives and all of the points that are in the legislation for the budget for New York State will help, and will help other projects, but this location does not receive any.
Now, New York lawmakers have authorized a new incentive to help affordable housing because that's really the issue here in New York City and across the country. Is that enough to really tackle the issues?
I think it's a part of it. It's not the overarching, it won't solve all of them, right? But it will produce a meaningful amount of apartments and put those onto the market and help the housing crisis overall. So it's not going to solve all the problems, but it's certainly one key part that will help the overall issue.
So you heard that, Shauna. We're moving forward, tackling this housing crisis that's happening here in our country. But during our 4 o'clock hour show, we are going to show the completed side of all of this. This is only the first phase that you're seeing right now, the demolition side. So I'm going to toss that back to you, Shauna.
All right, thanks, Danny. We look forward to seeing that here later coming up on Yahoo Finance. And of course, our thanks to Joey Chilelli as well.
Now let's take a look at the real estate market from coast to coast. With mortgage rates now above 7%, is there anywhere in the U.S. that a first-time homebuyer can get a good deal? Here to give us a breakdown of housing markets across this vast nation as part of our week-long special, Real Estate, the New Reality, is Orphe Divounguy, who is the Zillow senior economist. Orphe, great to have you here with us on the program today. First and foremost, we have to acknowledge the affordability issue right now. What is the best place where home buyers can find a deal or some affordability in the market?
Yeah, look, mortgage rates are driving most of the activity these days, right? So in February, start of the year, we saw mortgage rates decline a little bit. We saw a big increase in the number of existing homeowners listing their homes for sale. In February, new listings increased 21% from last year. And in March, unfortunately, mortgages started increasing again. We saw the new listings metrics start to ease again. In April, first couple of weeks, we see an increase again. And so mortgage rates really driving what's going on out there. But there are markets where homeowners are less likely to be affected by the big swings in mortgage rates. Those are markets that are in places that are relatively more affordable. They're in the Midwest. They're also in Texas and Florida. They're markets where the majority of homeowners don't even have a mortgage to start with. And, great examples are, your Detroit, Pittsburgh, Minneapolis. Those are markets where, you're seeing older homeowners with no mortgage listing their homes for sale. And that's providing a lot more options for potential first-time home buyers that are out there trying to get their, on that first rung of the home ownership ladder.
Are there markets, Orphe, that are actually seeing price cuts right now from the assessment and evaluation across the board?
Yeah, it's mixed. You're seeing in almost every market we have sellers. Sellers cutting prices. Right, 1 in 5 sellers cut their price in March. But at the same time, you have some sellers actually raising their prices in expensive markets on the coast, in the California markets. Like San Jose, San Francisco. A small increase in demand can push prices up higher, because there's just not enough inventory to go around. There's not enough sellers coming on the market to sell their homes in those markets.
So for those prospective sellers that are still sitting on property right now, where are we seeing the values rise the most? Is there one region that's having kind of an outsized moment of value and ultimately seeing those values move higher at this juncture?
Absolutely. San Jose, San Francisco, Seattle, San Diego, Los Angeles are markets where you're still seeing a lot of price activity, upward price activity. And it's not coming from, a big increase in demand. It's mostly coming from the fact that, there's not enough listing activity. You don't have a lot of sellers coming on the market to sell in those markets. And so that drought, right, in inventory is really pushing upward pressure on prices. Those are markets that don't build a ton either, right? If you don't have a lot of new construction, a lot of new homes coming on the market for sale, you're just going to continue to see that price pressure. And so those expensive markets just got more expensive this spring.
Orphe, it's interesting. One of the data points that Zillow has run as well is the median age of all listings. Where are you seeing some moderation there right now?
Yeah, so we're seeing that listings are moving faster in markets that are relatively more affordable. And so if you're looking at the Midwest markets, if you're looking at the South, especially, Austin's a market that's built a lot of housing. And so you're looking at markets that built a lot of housing, homes are selling slower. They're taking a longer time to sell. But if you're looking at markets that don't build a ton, or markets that are relatively more affordable, like in the Midwest, you're going to see homes moving a lot faster. And so we just came out with that study for first-time home buyers. And if you look, competition is really, really fierce in those markets where, homes are affordable. And so, those markets in the Midwest, you're going to continue to see a lot more activity. The good news is that sellers are also coming back in those markets because a lot of those sellers don't have a mortgage to start with, and so they're less affected by the big swings in mortgage rates that we've seen lately.
Just lastly, while we have you, Orfe, I mean, it sounds like there are some major corporation moves in region and how they might be setting up new groundbreaking facilities. I'm thinking of Intel and their own construction plants, chip fabrication that they're trying to bring online. That's jobs coming to an area. I'm thinking of whatever day of the week it is and Tesla and what takes place there. All of this considered, when corporations make these big announcements, what type of delta do you usually see in how the real estate values move in those markets?
That's right. And you're absolutely right. I mean, we saw that with the Amazon HQ too, right? We saw every time they announced something, we saw big activity, big increase in activity and home values increasing in those markets. And so, and what we're essentially seeing is firms are moving to where workers are, and workers are moving to where the jobs are. And so when our most recent analysis of mover data that we published in December really showed that ultimately what's driving the market is affordability. People are moving to places that are relatively more affordable with more inventory and a greater mix of housing options. And so workers are doing that. And so firms are looking for talent and doing exactly the same thing.
Orfe Divounguy, who is the Zillow senior economist, joining us here on the show today. Thanks so much for the time, Orfe. Appreciate it.
Pleasure to be on.
Certainly.
The rise of home prices in the United States is a reality you can't ignore. For many of us, our home is the most valuable asset we'll ever own. But home ownership is feeling more and more out of reach for many Americans. With mortgage rates near 7%, the average monthly payment is now over $2,000. Bankrate reports. These elevated rates are, however, being offset by a lack of supply. CoreLogic projects that year over year, home price gains will continue to rise at a slower pace for the rest of 2024. This could mean more of a foothold for potential home buyers. But the barriers are real. A Zillow report from February says new homeowners need to earn more than $106,000 annually to be able to buy a home in the U.S. That's an 80% jump from what Zillow projected a household could comfortably afford in 2020. Now, with the Federal Reserve expected to cut interest rates this year, many are hoping we could soon see some relief in the housing market. We cover all of this and more on Yahoo Finance's Real Estate, the New Reality.
Housing costs remain high across the U.S., and with mortgage rates topping 7%, buying a home seems even more out of reach, with many young millennials and Gen Z resigned to renting for the foreseeable future. But renting doesn't have to mean the usual apartment hunting. Many areas are now offering brand new homes available to rent called the build to rent market. Joining us now as part of our week-long special, Real Estate, the New Reality, is David Reynolds, who is the Mill Creek President of Investment Management. Great to have you here with us. First and foremost, just break this down. What is the growth that we're seeing in this rental home market, or the build to rent type market?
Yeah, no, the build-to-rent market, it's a relatively new concept. And just to define what it means, it's a purpose-built community of single-family homes available for rent. And these communities typically have amenities and they have dedicated property management. And if you look at the total universe of BTR to date, it's about 340,000 homes. And the expectation, this year starts are expected to be somewhere between 50 and 60,000. And that's down from a peak of 90,000 just a few years back.
So build to rent, but then on the other side of this, is there the opportunity for some of the tenants to be able to rent to own one day as well?
Well, there are concepts, there are groups out there that are looking at doing things like that. That's not what we do. We're fully focused on the build to rent product. And we like the product. We're filling a need in the market, and it's an affordable alternative, and it's appealing across generations.
And so affordable right now because there are many people that are perhaps blocked out from making a purchase, especially with mortgage rates the level that they are right now. And so without a cutting process initiated by the Fed on rates, how long is build to rent going to have some legs in this near-term period of time from your estimation?
Build to rent is definitely going to have legs for the long term. If you look at the institutional ownership of single family rental, it's only 5%. And single family rental represents about 11% of the total housing stock in the US. It's about 15 million single family rental homes. And at 5%, that means institutional owners only currently have about 750,000 homes.
How does the build to rent pricing compare to typical apartment pricing or typical other rental unit pricings?
It's going to be comparable to apartment living. If you were talking about a like location, by its nature, a lot of build to rents are a little further out, so you'd have to be comparing to like apartments. But you're getting so much more with the build to rent, and it's fulfilling a need, especially for groups like the millennial generation that has outgrown apartment living and is looking for more space and more privacy, and their families are growing. So, build to rent really fills a nice need there.
Is there any conversion that you later on look at from the Mill Creek side to look at a property and say, okay, this was built to rent, and now, at some point, we would like to list this as a unit or a property for sale? And what is the thinking that goes into that calculus?
That is not our intention. We're, built to hold. So we're building and we're teaming up with institutional investors who want to be in built to rent because it is viewed positively because it's actually expanding the housing stock in the U.S. and it's fulfilling a need. So not our intention. Most of our investors are long-term holders there, and to the extent they were not, we would probably look to see if we could somehow recapitalize and hold the property ourselves.
What are the hot markets that are seeing the most growth in build to rent?
Well, nationally, most of those are in the Sunbelt markets. And there's reasons for that because you have rapid employment and population growth, and they're more friendly towards businesses. And so there's fewer barriers to entry. So, the hot markets for us are in the Sun Belt. So, working from west to east, that's Arizona, Denver, Dallas, Fort Worth, Austin, Tampa, Orlando, Atlanta, Charlotte, Raleigh, Durham.
And when you're starting these construction projects as well and kind of breaking ground on a new community, the financing that you would be looking to kind of take on in order to get that started, where are you seeing new partners come in and want to provide that capital and that upfront to make sure that you can break ground and begin and complete construction?
Yeah, no, we're that's a great question. We don't close on land until we have all the entitlements in place. Most of our deals, all of our deals actually, we're doing with institutional investors. And I'm sorry, Brad, what was the second part of that question?
No, I think you were getting at it with regard to what the construction costs are and where you're saying, okay, this is. Yeah.
So what's, what the investor is requiring has gone up. The untrended yield on cost, so an unlevered measure, is now in the 6.75 to 7% range. And that's up 100 and 125 basis points from its previous peak. If you look at our average cost of what we're building, it tends to be around $350,000 per home. Things definitely have become more challenging with the rise in interest rates because we finance these with 55% debt, 45% equity, and that construction debt has been somewhere around 300 over SOFR, so putting you, in the 8+ range. The expectations are that interest rates will come down, and at completion, stabilization will recapitalize to a more attractive fixed rate permanent debt.
U.S. home builders came into 2024 on the back of a banner year that was 2023. Low supply in the resale market fueling higher demand for new homes. However, as mortgage rates climb and expectations shift now for interest rate cuts, where does that leave the rate-sensitive home building sector? Here to discuss as part of our week-long special, Real Estate, the New Reality, we have Jay McCandless, Wedbush Securities Equity Research Senior Vice President, joining us now. Jay, it is good to see you. So maybe we'll start there, Jay. You know, the market obviously is repricing, rethinking, Jay, the Fed's path to cuts. It wasn't so long ago, Jay, it was 6 cuts, and now increasingly we hear people coming on the show and saying no cuts. Larry Summers says maybe you should get ready for actually a hike. How does all this kind of impact and influence your coverage universe, Jay?
Well, thanks for having me on. I think what we've seen, we watched the 10-year rate, 10-year U.S. Treasury rate, and mortgage rates a little more closer than the Fed funds rate, and mortgage rates have been moving the wrong way. We're back above 7% now, solidly above 7%. That means the builders have to do more buy downs on mortgage rates and have to do some other things to try and keep these homes affordable. So yeah, the rate environment has gone from being pretty benign at the beginning of the year to being much more negative now than we would have expected, and that's why we're generally kind of neutral to bearish on the group at this point. Not because of lack of demand, it's just what's going on with the rate environment.
And you mentioned Treasuries, the 10-year yield is above 4.5%. What risk does that have on the housing market?
So I think for the housing market, you know, certainly, or not certainly, but typically will make mortgage rates stay high, stay at levels that just from an affordability standpoint, a lot of people can't make. We also think in certain parts of our other coverage, multifamily and in mortgage, the refinancing costs for some of these multifamily projects are going to go up. And I think that's a larger risk for some of the names we cover, is that being able to refinance some projects right now may not be as possible as it was earlier this year when the 10-year was below 4.5.
I'm interested, Jay, you know, on the other hand, we've had some of your colleagues, other financial analysts who cover these names, Jay, they come on and say, you know, investors should know that these home builders, it's a different kind of company than it used to be. They're more efficient than they used to be. You agree with that? Do the business models look different now?
I fully agree. They're from the group is carrying less debt than it was 5 years ago, and especially 10 years ago. They are building the homes certainly more efficiently than they were back then. But at the same time, it comes down to monthly payment, and the builders, I think, have done a good job of trying to shrink the size of the homes that they're building, reduce the amenities that they're putting, especially in some of the starter homes. But at the end of the day, if the mortgage rate's gone up, 100 and something basis points like it has this year already, that's just going to reduce the size of the population that can potentially buy a home. I think the builders also, are looking at ways to bring those, again, to bring the square footages down and find other ways to make these homes more affordable, doing attached product and some things like that. So, yeah, I think these are better run companies and generally better balance sheets than they were a few years ago. But at the end of the day, it's can the buyer make that monthly payment? And I think it's becoming increasingly difficult for some of these builders to make that happen.
And Jay, what do you expect when it comes to demand? Do you think demand will continue to stay high, or do you think buyers are waiting to potentially see mortgage rates come down? Do you think they just want to get into the market as soon as possible? What are your thoughts on the future demand outlook?
Yeah, so from a demand standpoint, we feel like the demand is going to be pretty solid for a few years, because you have the millennials, which are a fairly large population group in prime household formation years. The Gen Zs are right behind them, also starting to get into home ownership. So feel like the demand side of this is a really good outlook for the builders and going forward. But again, with rates having moved up and now with prices starting to accelerate again, we've seen home prices appreciate mid-single digits for most of this year. It's kind of both those things are working against those buyers. But yeah, with the need for housing is probably as high as I've seen it in my years of covering this group. So once we can get some rates and or maybe some home prices to come down a little bit in terms of what the builders are offering to consumers, then that'll help solve for that affordability challenge.
Any builders in your coverage universe, Jay, you still have a buy on here?
Yeah, we have on the manufactured housing side, we have a buy rating on Cavco Industries. They're a manufactured housing producer, national manufactured housing producer. We like that name from an affordability standpoint. We also like a small cap name, Lansea, LSEA is the ticker on that one, and we're outperform rated on that one. They're mostly coastal California, as well as down into Texas and Florida builders. So those are two names we like on the long side.
All right, Jay McCandless, thank you so much for your insights. We really appreciate it.
Thank you.